Great guest to dive into that. To start us off this hour, JoAnne Feeney, portfolio manager with Advisor Capital Management, and in her career, she has also consulted institutions such as the Fed. JoAnne, good morning. Happy Fed Day.
Good morning, John. Happy Fed Day indeed.
Let's start with your expectations for what the Fed will do today and how the market might react to that.
Well, I think the market has correctly baked in a 25 basis point increase. But I think that's less important than what Powell says about the Fed's view of the future. And, we've seen this play before. The market gets excited and thinks that the Fed's going to signal a move towards easing. And I don't think that's likely, given how much intractable forces still lie behind inflation in the United States and elsewhere, even though the inflation has come down from its peak.
So what's your general sense on whether or not inflation truly has eased, or, as some of the bears keep saying, once we get through this period of maybe taking a pause on interest rates, and I'm not suggesting the Fed's going to say that today, but the Bank of Canada has already said that there are these other factors out there that are going to remind us that the inflation story is not a short-term story. But where do you weigh in on the price pressures?
Yeah, so we've certainly seen inflation come down from its peak, and for good reason. There are a lot of transitory forces that are coming out of the inflation, great example everybody uses, used car prices are coming down, right? So we have those negative forces reducing inflation. But the Fed has signaled very clearly that it's looking really to the labor market to see the more persistent forces behind inflation. And, the labor market in both our countries, right, remains very tight. Record low unemployment rates, job openings are very large. And so the wage concerns are really what the Fed's going to focus on. And so even as these transitory forces come out, those wage pressures are going to remain. And if the transitory forces peter out, that is the negative changes in used car prices, for example, those come to an end, then you have the wage pressures reasserting themselves as a dominant factor. And you still have housing prices. Even though those have come down, there's a several-month lag, and those are still going to be putting upward pressure on inflation. So the Fed has a really challenging problem, and I think the market might very well be underestimating the work that is still to be done to bring inflation much closer to the 2% target here in the United States.
So that's helpful context on the economic storyline, and it's an interesting one because so long as I would assume people feel like with higher prices in their daily lives, they can go to employers and demand higher wages. That's the inflationary factor of concern. Of course, we have heard a lot about layoff announcements, too, so we'll see how that all plays out in balancing out the labor market. And then there's the earnings picture, and we're knee-deep in profit stories right now and outlooks, JoAnne, as you've been watching these last few weeks. Arguably, the bears would say that look less at the final quarter of last year and more at what the trend may look like when it comes to margins. And if there is pressure on profit margins, then there inevitably has to be potential pressure on stocks after the strong start to the year. Where do you weigh in on that?
Yeah, we've actually been focused really closely on the profit margin story. We know that margins went up to record levels during the pandemic as firms took advantage of higher prices and a lag in their costs. And so we do see a lot of room for margins to come down, and we think that could be a headwind to profitability and therefore valuations going forward. On the other hand, I think it's important for investors to recognize that what we have going on here across the world really is a non-uniform situation, right? We have some parts of the economies that are still growing pretty strongly while others are contracting, perhaps because they overexpanded during the pandemic. And, just take a couple of companies as an example, AMD versus Intel. Right, AMD reported this morning or last night better than expected and gave pretty good guidance. They're seeing a lot of strength still in cloud computing. We saw that from IBM as well. And yet Intel is suffering really from its own idiosyncratic problems in having gotten behind and lost market share and continues to lose market share. So I think from an investing perspective, right, there are opportunities out there for investors to find areas of the economies that are still growing, whether that's cloud computing or cybersecurity or infrastructure related. We have this big bill in the U.S. There are some good infrastructure companies over in the industrial segment that could be opportunities.
So let's stay on that theme before we go, because we like to give our investors ideas. And I will give you some kudos, JoAnne, because last year when there was just across the board pessimism on technology. You never shied away from throwing a few names out there, and I only bring it up because I get the storyline of worries around tech stocks, but if you're out of that sector so far this year, you're lagging the market heading into February. So you talked a little bit about some of those trend areas. Palo Alto Networks, this is an example of a name on your list, cybersecurity play out there. You even got, a company that is dealing with challenges like a big blue, IBM. I mean, they just announced layoffs. So what is the recipe for investing in that sector and others too? I mean, you've got some retailers on your list, and obviously they're dealing with some challenging times.
Yeah, well, so just tech sector broadly, right? A big headwind for the last, 14 months was the rise in interest rates. But clearly, interest rates have gone up a lot more in the past than they're going to in the future, even if we do see some more rate increases from the Fed. So that headwind now has dissipated. Maybe it becomes a tailwind, 9 to 12 months from now. So that makes tech a lot safer place to invest than it used to be. So that's a good area. And then on the retail side, we're seeing, again, unevenness. Unemployment's really low. People can get jobs. In fact, real disposable income in the United States has actually been rising for the last several months. Even though we hear about real wages not keeping up with inflation, at the low end, real wages are rising and disposable income is rising in real terms because more people are employed. So the consumer space isn't necessarily a bad space to be, but you want to think about how consumers are trying to deal with higher prices and a tighter budget. And so companies like, TJ Maxx, Target, these are places where consumers generally go to shop when they really need to save money on those, big or small ticket items that they really still have to buy.